Opinions expressed on the Ken Frankel Show are those of the host and guests and are general in nature. Nothing expressed on the Ken Frankel Show is intended to be specific advice for your individual situation. You should meet with a financial professional before making any decision that might affect you financially.
Hi, this is Ken Frankel. Welcome to this week's Ken Frankel Show, which we are solely sponsored by the Red Rock Casino Resort in Summerlin. Anyway, Jack had asked me a question, which I'm going to answer before we went to the break, which was about PE ratios and whether like 50 is bad and 12 is good. And it depends. But I don't want to just leave you dangling with it depends. I'm trying to give you the sort of the parameters what you need to look at. You need to know what kind of industry your company's in. Businesses that are highly cyclical, an auto company or a company like Boeing or a company that manufactures wallboard, they typically are actually, believe it or not, the best buys when the PEs are through the roof. Okay. And the worst buys when the PEs are low. And the reason for that is, by the time the PEs are low, we were at the end of an economic recovery.
Gotcha.
Okay, and the PEs are high when their earnings are very depressed. And usually that is when it's about to turn.
Okay.
So the PE ratio in and of itself could be deceiving if you're looking at a company but that is very in a cyclical business, anything that's industrial, again, cars, planes, related to homes, whatever. Now, if you're looking at a growth company like a technology company, now you have to be very careful about PEs. And you have to also ask how big is the company in general. If it's a really small company, it's like a micro cap stock, it may not matter because they're just at the very beginning of their growth and they can still grow a lot and they'll grow into that PE. But when you start dealing with companies that you hear a lot about on TV, on CNBC and Fox, and it's in Investors Business Daily, it's in the Wall Street Journal, then all of a sudden it's a known quantity. That's sort of then it becomes like gold. A lot of money then comes into it,
right,
and the trades become somewhat crowded. And I'll give you an example of what happens when you have a high PE on a tech stock. There was just one last week. I actually forgot the exact name of it because it's not a stock I happen to follow that closely. They're in something called, they're not even really in it, by the way. They're just peripherally involved with something called cloud computing, which is the new hot IT area. Basically, though, they're really in the data center business. They had like a north of 50 PE. And
50 plus?
Yeah, 50 plus.
Okay.
And they announced that their revenues going forward, while growing and still growing, were going to be just 2% light.
Okay.
Of what they thought they would be. And this is a company that is for the quarter, they do over $300 million in revenues, a sizable company. Just because they said they were going to be less than 2% light, because that valuation was so expensive, they took over 30% of the value of the stock inside of 20 minutes.
Gotcha.
It was gone. 30% down the minute it opened up.
So basically, again, being a trader.
Yeah.
All right, and saying, again, I'm not trading today, but let's just say if I was a trader.
Yeah.
What you just gave me, if I saw that would have been a good short. I would buy some puts.
You could buy. Well, there's two ways of shorting.
Okay.
And if you buy puts, that's the safest way of shorting, because then you're limited to what you lose to whatever you pay for the put premiums.
Okay.
Okay. The downside with puts is that the stock has to collapse within the time frame of your put.
Gotcha.
And very often, most options expire worthless.
That's the truth.
Okay. So that's the problem with that one. Okay. Even though there's nothing wrong with it, but you need to understand the risk of it. The other way is to simply just go short the stock.
Right.
The issue with shorting the stock is you have infinite liability because they can price that stock anywhere.
Right.
And you're responsible for all the difference as it goes up. So there are certain, and I'll tell you this is the best advice I can give you. There are certain types of companies you should never, ever short. And I'll tell you, and it's almost logical, but I'll tell you which one it is. Never short a company that's in like biotechnology, because God forbid you're short and they announce they found a cure for cancer.
Bang.
You're done.
Yeah.
You're bankrupt at that point.
And you are literally responsible, and I think a lot of people's understanding, like you said, using an option like a put is a predetermined risk level.
Exactly.
Right? You purchase an option, I spend $800, whatever that number is,
right,
and that's the worst that can happen to me.
Exactly.
Obviously, I got to make back my $800 before I start seeing profit.
Right.
That's where the difference comes on the profit potential, because
right,
when I short the market, I'm just like commodities, it's dollar for dollar. It goes my way, okay. But on the other side, boy, oh boy, I could lose 10,000, 20,000. I know being in commodities and being on the wrong side as a broker, I one day raised, I think it was $1.9 million in a matter of 6 hours from my clients, and it was all margin calls, because they were all on the wrong side of the market. So
Right.
again, like
And you have more protection in commodities than you have in stocks. So as you know, and you could explain it better than I can, but the commodities have limit up and limit down.
Right.
Okay, you don't have that
no
in the
limits.
stock market.
Right.
There's no limits.
Being short in the stocks, like you just said, you really better have some serious capital. And even if you put a stop up there or be able to try to protect yourself on the trade, it can fly right through.
No, let me tell you how you would protect yourself. We okay on time? Okay, let me tell you how you would protect yourself on a short position. Okay, buy a call option on the same security, and then you limited your downside at least for the period that the call covers.
Gotcha.
Because at that point, let's say for example you were short a stock at $70 a share, and you didn't want to take a risk of more than $10 a share. You could buy a call option with a strike price of 80, and then you're protected on anything above 80.
Gotcha.
And that's the way, and that's what I actually
So
do.
it's a little insurance policy that you're buying for yourself.
Right.
Right.
Options are interesting because, and we talk about, you see it in the media all the time about derivatives. Derivatives, and I've said this before in my other shows, are like pharmaceuticals. Okay, they can make you better, they can help you, they can make you, or they can kill you if they're used wrong. Options are derivatives. If you use them as we just described as an insurance product to protect your downside, then it's conservative. But if you use it for speculation, it's very high risk.